Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CBRE Group INC quarterly report. CBRE Group Inc. offers a wide range of businesses and services across the globe. The company's key offerings include advisory services, leasing, property sales, commercial mortgage financing, property management, valuation and consulting services, global workplace solutions, facilities management, project management, building consulting, program and cost management services, real estate investments, investment management, development services, real estate development, and investment activities. These services cater to various clients including owners, investors, occupiers of real estate, pension funds, insurance companies, sovereign wealth funds, foundations, endowments, and other institutional investors. The significant increase in CBRE Group Inc. stock price over the past year can be attributed to several key factors. The company's strong financial performance, including earnings beats and revenue growth, has been a major contributor. Additionally, the expanded stock buyback program and strategic acquisitions have demonstrated management's confidence in the company's long-term value. Analysts' positive ratings and price target increases have also boosted investor confidence. Leadership changes, such as Andrew Horn taking over as principal accounting officer, reflect the company's focus on strengthening its financial leadership. The broader market optimism and real estate industry confidence have further contributed to the stock's performance. Overall, CBRE Group Inc.'s consistent expansion of global operations, adaptation to evolving market demands, and robust financial results have driven the stock price increase by 23.56% to 43.37% over the past year. The primary drivers of revenue growth or decline can be summarized into several key areas. On the growth side, property sales revenue increased by 29.5%, led by office, industrial, land, and data centers in various regions. Global leasing revenue rose 17.6%, driven by data centers, office, and industrial leasing in the Americas. Additionally, double-digit increases in property management and facilities management fees were attributed to growth in clients. On the decline side, a decrease in incentive fees of 13.5% was a significant contributor. Charges related to indirect tax audits and settlements also negatively impacted revenue. Furthermore, net fair value adjustments on strategic non-core investments and provisions associated with Telford's fire safety remediation efforts also contributed to the decline. Economic factors such as capital market volatility, real estate investment performance, and client willingness to make commitments also played a role in shaping revenue growth or decline. Overall, these drivers highlight the complexities of revenue growth and decline, influenced by both internal and external factors. Net income and profit margins experience significant growth. The company's net income has seen substantial growth, increasing by 61% for the 3 months ended September 30, 2025, and 54% for the 9 months ended the same date. This upward trend is also reflected in profit margins, with a notable increase in net margin from 2.72% to 3.86% over the 3-month period. The reasons behind this growth are multifaceted. Revenue expansion has been a significant contributor, as well as a slight decrease in operating expenses as a percentage of revenue. However, cost of revenue, excluding pass-through costs, has increased marginally to 39.9% of total revenue. Despite these factors, the company's net income and profit margins have demonstrated resilience and growth, indicating a strong financial performance. The company is generating a significant amount of positive operating cash flow, with an operating cash flow of $3,478 on page 1 and net cash provided by operating activities totaling $338 million for both the year page 4 and 9 months ended September 30, 2025, page 61. It is clear that the company's operations are generating substantial cash. This indicates a strong financial position and ability to meet its obligations. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, total long-term debt increased from $3,320 million to $4,446 million, page 25. However, by September 30, 2025, this figure had decreased to $12,189 million, page 63, indicating a fluctuation in debt levels. Regarding interest expenses, the company has seen a notable decrease. In 2025, interest expense, net of interest income, was minus $14 million compared to $64 million in 2024, page 2. This represents a significant drop of 21.9%, page 45, and 2.5%, page 46. The 3 months ended September 30 also showed a decrease from $64 million to $50 million, page 67. These changes suggest that the company's debt level has been subject to fluctuations, while interest expenses have decreased significantly over the past year. The company's financial performance reveals mixed results across different segments. The core corporate segment performed poorly, with operating losses increasing by 13% and 22.3% over 3 and 9 months respectively. In contrast, the other non-core segment showed significant improvement in equity income, turning a $10 million loss into a $1 million gain in 3 months, and a $102 million loss into a $24 million gain in 9 months. Management's outlook for the company is cautiously optimistic. They acknowledge uncertainty due to potential litigation and its impact on financial statements, but have implemented strategies to mitigate risks through loss-sharing arrangements and cash reserves. The company is focusing on revenue growth driven by advisory services and real estate investment segments, with a strong presence in various regions. To support growth, management is investing in acquisitions and integration activities, while also prioritizing cost savings initiatives and improving operating efficiency. They anticipate sufficient cash flow to meet future requirements and may refinance existing debt instruments at attractive interest rates. Management's strategy involves diversifying the revenue model to offset cyclical economic trends, leveraging the global services platform to maximize long-term cash flow, and maintaining assets under management while adapting to regulatory changes. They are also committed to retaining key personnel, executing information technology strategies, and implementing effective internal controls over financial reporting. Acquisitions and divestitures overview. The company has made several key transactions in recent times. On the acquisition front, Relam Amsterdam Holdings BV entered into 2 types of term loans: tranche A USD term loans and incremental USD term loans. These acquisitions are aimed at securing necessary funds for business operations. On the divestiture side, the company has decided to wind down its legacy construction business through Telford Homes, as well as certain businesses within the BOE segment. This strategic decision is likely intended to streamline operations and focus on core areas of growth. The company's financial summary reveals that it has engaged in a share buyback program. Specifically, the total authorized amount for this initiative was $9 billion, with a significant portion of these funds being utilized to repurchase 5,185,163 shares at an aggregate value of $663 million. That concludes the financial summary for CBRE Group Inc. Feel free to comment below, and I will be happy to answer them when possible.